have a pretty robust conversation here. So I'm gonna kick us off. My name is Adva Saldinger. I'm an associate editor at DevX, where I write about development finance. And, you know, one of the things that I've written a lot about in the last couple of years is sort of the growing role of DFIs. And they're lending more in the past decade than they ever have before. And they have a really important role to play sort of in this space, particularly in the response to COVID. And I think that there has been a lot of discussion about, you know, what is their responsibility in this moment? How will they respond? What sort of risk will they take? And you know, as we look forward, what is the role of DFIs in the recovery, particularly of, you know, emerging markets and the poorest countries? And so I'm joined today by a really great group of panelists. Yasemin Lamy, who's the Deputy Chief Investment Officer for Catalyst Strategies at the CDC Group. Jessica Espinoza, who is the 2X Challenge Chair and the Global Gender Finance Lead at DEG Invest, and Uli Grabenwarter, who's the Deputy Director of Equity Investments at the European Investment Fund. We'll go to them in 1 second. I imagine you're all quite familiar with Zoom by now, but at the bottom of your screen, you should see a Q&A icon. If you have questions throughout the conversation, please send them to us in that chat box. Let us know who you are, your name, your organization, and we'll get to as many questions as we can in the end or even throughout the conversation. So I want to turn to our panelists. And the first question I really want to ask you is, you know, early on, at least, you know, from what I saw in my reporting, a lot of DFIs were really focused on their portfolios, working with their sort of existing clients, and doing a lot of liquidity financing. And so I'm curious to hear from each of you sort of what your approach has looked like to the COVID response and how that's evolving as we sort of move towards more of a recovery period, or as we look ahead to what a recovery looks like, and you know, how your organizations are trying to wrap your heads around what your role is in response to this crisis. And Yasemin, maybe we'll start with you.
Thanks, Adva. It's a pleasure to be here. Thanks to everyone who's joined the panel. I thought I would start with a little bit of color on what happened at CDC when we all went into lockdown. So, you know, we're all remote. You don't see your colleagues anymore. You don't see your portfolio companies anymore. No one can get anywhere. Desperate for information, looking to connect. And what I started to notice was, first of all, everyone was concerned about the existing portfolio companies. We'd worked so hard. We've been investing for over 70 years for job creation and other impacts. So we need to preserve that as much as we can. And secondly, there was actually this little bubble of energy. There was like little popcorns showing up all over the place of, I could just see my colleagues saying, we have got to do something. What can we do? We've got capital. Where should we be putting it? And where are there opportunities to actually support a response to this crisis? And so we pulled together a 3-pillar structure to our COVID response. The first was really about preserving impact, safeguarding the companies that we had partnered with in our portfolio, making sure that they had the capital that they needed to weather the storm, but more than capital, that they also had guidance from our teams and others that we could work with to help them navigate shifting to a remote workforce, employee health and safety, and, you know, in incidences where retrenchment would be required, how best to manage that challenge. And then we built a pillar around what we called strengthen. And that was really looking to help companies in our portfolio where we could see an opportunity for them to step up at a time of need, and in particular looking to work in the health sector or food security as key challenges, and you know, thinking about how they could scale up with capital that we could provide to really grow their business at a time when there was increased demand for their services. And finally, we had the pillar of rebuild, which was really thinking about, you know, we've always been a long-term partner, we will always be a long-term partner in the markets where we invest. And we put together that 3-pillar structure. We expected to look at the rebuild segment of that, you know, not until Q4. And the really positive news is that we've actually been able to accelerate opening up to our broader pipeline sooner than we thought. So there's still a lot of, obviously the crisis still has a lot to demonstrate in terms of how it's going to play out and what it's going to mean in our markets. But we're quite pleased that we've been able to actually accelerate how we look at those longer term investments than what we expected to be able to do. Adva, I think you might be on mute.
I am, thank you. Jessica, do you want to jump in and then let us know sort of how DEG has approached this? And I know also the sort of 2X group came out with sort of a statement and a push early on.
Yeah, sure. So on DG side, as you mentioned, we have also very much focused on fast liquidity response initially. And I must say, also in comparison to previous crises, I think our liquidity response was quite fast and also quite flexible. To give you an example, usually our mandate requires that we have maturities in our financing of at least 4 years. But with this crisis, we were able to offer liquidity lines, especially for financial institutions, with much shorter maturity, so just 6 months, for example. So to really be fast and tailor our response to the specific needs in the market. Besides liquidity, and our liquidity efforts have mostly focused on existing companies and customers. We've also been quite fast in our COVID-related advisory services, because we realized that it's not only liquidity. I mean, this is really an unprecedented crisis, and there were so many multiple challenges at the same time, like how to preserve jobs, how to keep workers safe, so many different things. And so our business support services team worked really hard to come up with a range of different advisory services that can be tailored to the specific business model and the local context, but that has a clear focus on key topics needed at that particular time. So for example, healthcare response, how to switch quickly to remote working and install digital solutions, but also like how to, many different aspects, as I'm sure you're all familiar with in different sectors. And then what for us, I think has been extremely helpful is the collaboration among DFIs. So in terms of coordinating our response and making sure that where we have shared investments or shared customers, that we kind of go in a coordinated way and make sure that we support them the best we can collectively, and to avoid a situation where perhaps everybody's just trying to save their own investment. So that has also worked quite well. The 2X challenge and these kind of thought leaderships groups have helped us to tackle key challenges together. So for example, all of us have had quite a strong gender lens in our investments recently, but with this crisis, there are of course many new challenges, because on the one hand, you want to be fast, but you also want to make sure that the response is meaningful and that you keep that gender lens. And so I think the recommendations that the 2X Challenge and the Gender Finance Collaborative have developed and kind of also made as a joint DFI commitment have been extremely helpful to go into that direction together. We've also done an interesting risk mapping, and just being conscious of time, perhaps I can share more about that a bit later, but that was also really interesting to kind of quantify and really see the impact that's at risk beyond just the financial risk that we're seeing.
Great. And Uli, tell us a little bit about how, you've been responding and how you sort of view this response thus far.
Yeah, I think I'll start like Yasemin with a little flashback on what happened in March when we all went into lockdown. I think we still were all playing with scenarios of how we are going to organize business one day to the other when the situation that actually has been pretty dramatic already in Italy at the time is going to spread across the continent and the like. And those events have basically overtaken us from basically overnight, and we realized suddenly that this is going to be much bigger than anything that what we had anticipated. And I think our reaction to that has been twofold. First of all, there was a huge energy mobilized to direct towards action that would keep the system alive. I think that was the first response, and not only from the EIB group as such, but also from all the stakeholders of the EIB group, member states of the European Union, European Commission, have taken very bold measures in order to fuel the system and avoid a kind of lockdown of the economic motor as such. But I think next to that, in parallel, and that's something that we are very busy even today, is to look at measures that actually make us more resilient for this type of situations in the future, because there's obviously one urgency that we need to deal with, which is to cope with the direct impact of the COVID crisis on all type of stakeholders, on communities, on economic sectors and the like. But the second dimension, which is potentially even more important, is to look for us into the future and see what do we need to change in our patterns that we've applied to our businesses in the past, that will help us to not to live through the same type of situation again in the future if something similar occurs.
And we'll talk a little bit more about that, sort of the impact of this crisis on how DFIs are looking at prioritization and decision making, and you know, how maybe it's, you know, shaken you a little bit and made you sort of think about some of those issues. I wanted to bring something up that Jessica mentioned, which is this idea of collaboration. And I do think we've seen it in response to this crisis. DFIs have come together to talk about, you know, how they could share due diligence processes, for example. And I'll push you guys a little bit on this because, you know, people don't like to talk about it too much, but DFIs often compete with one another in ways that can, you know, either potentially crowd out private capital or maybe not be, you know, the best way to achieve the sort of development outcomes that you're after. And so I'm curious, you know, what those processes have been like around collaboration in this crisis, and whether you think some of those mechanisms could stick in the long term, whether we might actually see some better coordination and collaboration in general among sort of the DFI system coming out of this.
Should I start?
Sure.
I mean, I hear your critique. I'm not sure I agree with it. So my answer might be less than satisfying if our starting points are different. But I think moving forward, I see a lot of potential to collaborate. We had an investment committee this morning, for example, where we have had to partner with another DFI who's looking at the same fund manager with us in South Asia, and we cannot really get on the ground to do our due diligence from an environmental and social respect. So we've been able to do a lot of the rest of the due diligence in a remote fashion, and that is quite a technical expertise that we can't currently source. So we're going to have to use a third party who can get on the ground, and we've decided, you know, it's best to align with the other DFI and do that together. So that's a live example from this morning. I think we've done a lot of partnering too on broader principles of how we want to engage. And I think this is what Jessica was talking about. Even things like if we want to agree interest deferrals with our borrowers, how should we be approaching that question in a way that's consolidated and consistent across the group? You know, we all have the same objective at the end of the day. We want these companies to survive through the crisis. We want them to have what they need to protect their employees and their companies. We are long-term partners, so we need them to think long-term. And the 3 months, you know, interest rate conversation is something that we're happy to engage on. And I think we've seen a lot of positive collaboration there with our co-investors. But I'll let the others jump in on the question.
Fully.
Now, I'd like to take a couple of perspectives on that. I think my first observation would be that as much as I do agree with you that at times the DFIs are not pulling into the same direction, in this very specific situation of the COVID crisis, I don't think that there was any room for competition. When this news actually hit the headlines and hit us all into the face, I think there was a genuine will and motivation of all the national and international financial organizations to actually step up their activities and try to amortize the impact of this crisis. And I think even EIF in the programs that we have started implementing and the EIB group at large, we have seen a great readiness of cooperation between DFIs at national and international level to do so. What I would, however, from a more macro perspective, maybe highlight is that I think in the type of situation like the COVID crisis, it becomes increasingly clear that we may have a more structural issue with the relationship that the DFIs have with the financial system at large, which is that over the recent years, DFIs have been very much forced into a role of being subject to the same supervisory roles and capital requirement roles as the normal banking sector, which actually led the DFIs to behave very much in line with the private banking sector and not being able to push the boundaries anymore into the areas where nobody else goes. And I think that is a requirement that this COVID crisis has brought back into our mind, that we are actually in a situation where we need to equip DFIs much more for the risk-taking that can actually lead to a constructive and an immediate response to this type of emergency situations as we have it now, rather than having to go to cycles. How can they adjust actually their own operating setup to meeting those requirements? So that's one of the issues that I see. And the second question was that we have been asking ourselves proactively was how do we actually trade priorities in the action that we need to conduct? How do we, that we have been called basically over the last 18 months to step up dramatically our activities in terms of response to climate change and the like. How do we place this compared to the COVID crisis that we need to deal with? And we have been discussing whether we need to prioritize or deprioritize and things like that. And we've come to the conclusion that actually we have no choice. We need to take that on as an ad par urgency, but we cannot shelf another activity that we have been making our priority over the last 18 months because something more urgent has come up. Unfortunately, we have come to the conclusion that the time where the areas of intervention that we have to deal with come in the shape of a Maslow pyramid that doesn't exist anymore. And we need to basically respond to all at the same time. And I think that is a very important challenge that DFIs are facing today.
Jessica, I wanted to follow up on something Uli said with you, which is sort of this tension because of structures of a lot of DFIs around, your risk in your portfolios and how you can sort of achieve your financial objectives. And especially at a time of financial crisis, when a lot of your investments may not be performing in the way that you thought they would. How are you able to sort of continue to do the work that you need to do as a DFI? What are the challenges that brings up in terms of the way that you're structured, and what could or should sort of change in that regard?
I think there are probably two different areas to look at. So one is the core business and how the core business is, and with that I mean the way we currently do things and the products and the type of investments we're currently able to do. And if we look at that, I think coming together and really collaborating, as the other two panelists have described, has been extremely helpful. Because when the crisis hits, you immediately have a lot of competing interests, like your credit committee challenges you, is this bank going to survive? And perhaps you, from an impact perspective, want to work with the bank to make sure they keep their focus on SMEs, or even to keep their focus on women-led SMEs. But the credit committee may be more concerned with the survival of the entire bank or the systemic risks. So there you have, I think, different levels of discussion. And it's of course always a balance between making sure you keep that very specific impact focus, while also keeping in mind the overall risk strategy of the bank and simply ensuring its survival because of the surroundings. That said, I think we've been, that has worked quite well by coming together and making sure that we DFIs stick together. And there's not kind of as you described, a competition of who leaves first and who is left with the risk, but that we agree that we're all staying or we're all acting in the same kind of way. I think that has worked well. And what I have observed, what makes it much more difficult, also because of the banking regulation that we're subject to, is when it comes to more innovative solutions. For example, there have been new fund structures or new financing structures specifically developed to address the new challenges that arise with COVID, and the kind of support that is needed on the ground. And when we then take that to our investment committee, it's very difficult because usually it requires a new product, kind of a product development process. So we don't have the internal processes in place to do that kind of investment, or it's too different to what we have done in the past. It's also, of course, then you have to invest more capacity and more time because it's not just a quick win that goes through the process. However, the impact and in terms of the response to what is really needed may be much greater. And I think that's where we have faced a lot of challenges. Part of it is because, as Uli mentioned, we are often treated regulatory-wise just as any other bank, which makes it very difficult to assume more risk and have that focus. I think the second factor is that, for example, when we provide technical assistance or any other type of advisory services, we often do it either through our retained earnings or through funds from the ministry. In times of COVID, where we barely make a profit, if at all, it's very difficult to rely on those internal resources for that kind of support. And so we rely heavily on public funds from the ministry. And I think the third aspect is our capital, and that's really a major constraint. So if you go into more risky countries or more risky companies, you have to have more internal capital. So the capital requirements are often a limiting factor. And that's why I was very curious to hear from Yasemin as well that she's leading an initiative at CDC that seems to have tackled that issue.
Yasemin, do you want to tell us a little bit more about Catalyst Solutions and how CDC is trying to sort of take on more risk by creating a separate portfolio?
Yes, I would love to. So I'm going to start with a little analogy that we use. This is what everyone remembers, even if I present for an hour, this is what they remember, so I'll use it here. So when we at CDC a few years ago, we created this pool of capital called Catalyst, and you know, most of our portfolio today, it's still 90% or more of our portfolio is still growth capital. And so I'm going to give you an analogy between growth and Catalyst using this pen. So in our growth portfolio, our deal teams will go out into the market. They will look for a pen. They'll they will check the pen out. They will test that it writes. They'll take it to investment committee and they'll ask, can I buy this pen? Yes, great, put it in the pocket. They might find this pen. They'll go nosing around. They'll source a cap. They'll put the cap on. They'll take it to investment committee and say, can I buy this pen? Yes, great, put it in the pocket. With Catalyst, we find a cap and we can imagine the whole pen. The cap doesn't even write, right, at the beginning. But we can imagine that we can construct this and then we take it to IC and we can put it in our pocket. It's a space where we can be more of a builder. And we were very lucky with the timing of Catalyst relative to COVID, because we just spent 2019 putting a lot of definition and architecture around Catalyst and what it means for CDC. So it has two key questions. So what is the impact you're trying to achieve? We're always looking for an enhanced development impact, and we have a robust framework around what that means, who the end beneficiaries are, what kind of impact are you trying to have in a direct way on those beneficiaries, what kind of market level impact are you trying to have? So all of that is a fundamental question. And then alongside of that is, well, what is the risk profile? Because fundamentally, Catalyst is all about shaping nascent markets and taking a flexible approach to risk in exchange for pioneering impact. If we hadn't had that in place, I think COVID would have been a very different experience for us. But given we had the processes in place, you know, and our board members came to us and said, do you have the tools you need to respond to COVID in the way that you want to? And we took a good look at it, and we were able to say yes, and it allowed us to move very fast. And so with Catalyst, one of the things that we were able to do very quickly in the early stages of the crisis, I think the investment committee was even held in April or early May, was to use one of the oldest forms of financing, tried and tested trade finance, and approach it in a way that was much more innovative because we had this Catalyst tool available. So when we work in trade finance, we typically partner with a bank. We say to the bank, we will risk share with you on the trade financing transactions that you are underwriting. And what we did was we said, we will give you preferential terms on that risk share for impact priorities and we'll put that in the catalyst bucket. And so we were able to, we as a part of our COVID response, we started with laying out our Maslow needs hierarchy of impact priorities. And then we were able to say, if you go into healthcare, you go into food security, water and sanitation, we didn't expect a lot of, but it was on the list, then we will give you preferential terms. Also, if you go into the hardest geographies, we will give you preferential terms on that risk share. And so it was fundamentally a very old-fashioned instrument, which actually with just this little tweak, we were able to be quite innovative and use this existing facility to get capital to the places that needed it most. But I think what was really important was that it was something that we could do at scale, something that we could do very quickly, because you're doing a bilateral agreement with a bank. We had those partnerships in place, and it was actually fairly simple because you didn't have this multi-stakeholder, get everyone around the table challenge that you can have sometimes with fund structures. And just as a little plug, we published today in Impact Alpha on how, we're often in this world so focused on innovation, which is exciting, and I'm the first one to be around the table for that, but we can also forget sometimes the power of some tried and tested tools, and I just wanted to make the plug for that today as well.
Picking up on that, we had a question come in that asks, how did you come up with different product solutions? And I think you've sort of answered that a little bit, but wanted to open it up to Jessica and Uli as well about, how did you come up with product solutions to sort of assist your clients in response to this crisis and getting at a conversation we've had, how could you do that and still achieve some of your internal financial objectives? So I don't know if Jessica or Uli, you want to jump in with some of the products that you've been looking at or things that you're sort of looking at coming up in terms of the response or recovery.
I can.
Or
go ahead.
After
no,
you.
go ahead. No, go ahead. Ladies first.
We've been looking kind of at it from three angles. One is financing products and solutions, and then advisory services and technical assistance, and also leveraging our network and new partnerships, which I think hasn't been a strong focus in the past, but where we have seen really exciting new opportunities. And the first one, as I mentioned, we were quite quick within kind of our possibilities to come up with new products depending on the specific need of customers. So for example, these liquidity lines with maturities that are much shorter than what we have done in the past, that has been possible. We've also seen, and I think that kind of is in line with what Yasemin mentioned, we had already piloted a few more innovative promotional programs, kind of more venture-focused strategies or risk-sharing products in the past, and then we were really able to ramp these up when the crisis hit. So I think that really shows that it's worth investing in those solutions in good time, so you have the systems and everything in place and can easily ramp it up when a crisis like this hits and those instruments are particularly needed. Then on the advisory front, there as well, we have a lot of flexibility. This has always been very demand driven. And we also have a large network of consultants. So when we saw, for example, that there was the need for healthcare solutions or for crisis management solutions, we brought together the best consultants from different geographies and structured these advisory products that were very much tailor-made to the specific needs of the companies. That has also worked well because we had that experience in place and could just tailor it to the crisis situation. And what I found really interesting was the experience to collaborate with other DFIs, especially in the 2X challenge, and to seek new partners that we hadn't collaborated with before or not to the same extent. And this experience actually shows that it doesn't always have to cost money. You can really leverage the DFI network and partnerships to bring solutions to the customers that are very much valued but don't necessarily cost anything. And an example of this is a recent webinar that where we convened financial institutions from all continents in a webinar. So it was kind of a networking and peer learning event. And we brought on board Goldman Sachs as a new partner. And they shared their solution, kind of non-financial services solutions for women entrepreneurs that are digital, they're free of charge, any financial institution can implement them. And the response from our local partner financial institutions was amazing. They immediately integrated it into their offer. They were able to offer something very tangible to local women entrepreneurs, and it didn't cost them anything. And this networking opportunity allowed them to connect with other financial institutions in other markets and to learn from like their approach to support also non-financially in this crisis. And I think that shows that we DFIs can be much more creative and really recognizing the various resources and connections we have and just getting value for our customers out of those.
Great, and Uli, we'll go to you, but just a reminder, if you have questions, type them into the question box and we'll try to answer as many as we can. Uli, please share your thoughts.
Yeah, I'll be brief on that one to save time for Q&A as well. But I think the immediate response that we had was really to not reinvent the wheel and to try to work in the first instance with products that we had already in the market and just to increase the scale and accelerate the processes that brought liquidity into the market, because that was the most important urgency to be met in the first place. I think in the second stage, we are now looking at what products do we need to develop to address the victims of this situation that normally would not have needed the products that we are offering in normal circumstances. And if you look at, for instance, in the equity space, there are plenty of business sectors that are not typically suitable or not typically in need of one of the main products that we are operating, which is venture capital and private equity products, but that became victims of that crisis in the sense that today they do need equity because the lockdown and the fact that they have not been generating any revenues for several months has eroded their capital base in a way that today they do need capital. And those companies and those sectors are not necessarily the primary target of typical venture capital and private equity firms. And for those, we need products that actually can provide this type of support without altering the dynamics that are linked to those industries as such. For family businesses, for instance, they may be in need of equity today, but they're not necessarily looking for having a shareholder that wants to exit the business in a time frame of 3 or 4 or 5 years. And that's something which I think is the focus of our current consideration, that we try to come up with products that address that.
Thank you. I wanted to go to one question we had, which is, what's your response to feedback coming from emerging countries who are saying, where people are saying that COVID money from DFIs isn't reaching them? And so, are you able to reach either, the poorest countries or the most vulnerable people with your existing strategies? Obviously in a time of crisis, it's probably that much harder to pivot to a more, to a more risky portfolio, but how would you respond to some of those concerns, and how are you incorporating that in your work? I don't know which one of you wants to jump in first.
I kind of have a go at that, because I think I partly already touched upon that when I started opening, saying that we need to equip the DFIs with the risk absorption capacity that allows them to address the situations. Yasemin was giving the situation of CDC, and I think that is really indeed a very fortunate situation to be in, that you are equipped at the right moment in time to have the right products and the right risk-taking capacity to come up with the right response in a timely manner. But I think a fact is that we, across the DFIs, we do lack this readiness of risk-taking, even in normal circumstances, let alone in a situation that is accelerated like now in the COVID crisis. And I think one of the main challenges that DFIs need to meet in that context is that we become more aware of the outcomes that we actually expect from the activity that we are doing. Because simply mobilizing the capital for given sectors and being able to intervene in a given sector, that doesn't solve the problem as such. And I think if we actually get this circle of accountability on one side and risk-taking on the other side, to the awareness of the different stakeholders of DFIs, we would come to a situation where we could potentially increase in a more pertinent manner the cooperation between the DFIs, because they would work towards joint goals that they're pursuing in full transparency. But we also would probably get a a higher degree of readiness to equip the DFIs with the risk-taking capacity that they need to bring direction to the market.
I might add on to that, Adva, if that's all right. I think, you know, I probably painted a slightly rosy picture a minute ago in terms of our COVID response. It's been challenging, of course, as well. And one of the biggest challenges is at a time of crisis, no one, it's not just DFIs, everyone is stepping back from taking risk, right? So in our conversations with banking partners, it was really important to us that the conversation was about, we'll step up and take risk with you together into the market. We will not take risk off your balance sheet. There were some conversations that came to us that were, you know, banks asking, will we de-risk their balance sheet? And that's not what we're here to do. And so this, you know, there was definitely a behavioral negotiation around what are we trying to achieve with these transactions that wasn't straightforward in the first instance. And then I think, you know, what is important for us is with a tool like trade finance, we actually receive monthly monitoring reports on where the capital has gone to in terms of what invoices have we backed, you know, and we can get data on that pretty much straight away, which is a significant change from our traditional kind of equity or debt business where you get impact data maybe annually. You know, the first data point might come in 12 months after you've invested. And so we're committed to being quite dynamic and reviewing the data that's coming in to see, you know, is it having the effect that we hoped it would with the incentives that we designed.
Can I just add very quickly? At DG, we've done a risk mapping, and I'm quite proud of that because it really puts impact at the center and not so much the financial risk. So it's completely looking with an impact lens at the impact at risk. And so we've analyzed our entire portfolio, not only based on historic data, but also combining different data sets and then also really engaging directly with clients. And so we've identified those companies where most jobs are at risk, where most local income is at risk, and where community spendings are at risk, and have prioritized our response accordingly. And I think that's really a kind of a new way of looking at responses and prioritizing, and that has worked quite well for us. That said, we also saw that we could really use the private sector as a vehicle to channel COVID-19 response also from the public sector much more efficiently and much more quickly, using the network and the proximity of companies to local communities. And I think in many cases, this may have worked better than going through the typical public sector channels. And I think like that for me is a key lesson, that going forward, it would really help to have a closer partnership between the public sector and the private sector, and to see how also public response can be channeled through DFIs and their private sector network to local communities much more quickly and efficiently.
Right. We have a question about, you know, given that the fundraising environment for funds, particularly in emerging markets, is even more challenging than it was before, which was already challenging for many of them, you know, how important is the role of DFIs? What can the role of DFIs be in supporting emerging fund managers, you know, who are looking to really make impact investments and hoping to launch, you know, still in this environment, a first or second fund? I don't know if any of you wants to sort of jump in at, you know, whether you're looking at those types of investments or, you know, what you see as your role in that.
I'm happy to kick off. So that's one of the main challenges that I was referring to earlier, like really important solutions that we are seeing now, but that simply don't fit the current way of doing business, the current processes, and also the capital requirements. So we really see restrictions there. But we're currently piloting a very interesting solution among the 2X Challenge members. It's still under development, but we have an initiative that's quite advanced and that really looks at tackling collectively and holistically this major systemic issue of first-time fund managers, many of whom are local, are African fund managers, and are female. And yeah, so I'm really looking forward to sharing more, hopefully in the fall later this year, and CDC is very much involved in that as well.
Uli, we had a question come in specifically for you, asking what impact sectors EIB sort of sees as priority action areas moving forward.
Well, I think this is a question that is divided into what is immediate and what is mid to long term. I think the immediate focus of the EIB group in responding to the COVID crisis was unemployment, clearly to keep people in jobs, to keep the economy going, that we are not ending up with unemployment rates that surpass what we've been experiencing in the 2007-2008 crisis. But as I said before, we had a very conscious discussion about what does the COVID crisis and the impact on the economy mean with respect to very many other agenda points that we have, and that are urgencies in the action that we need to pursue, and notably in the context of the climate crisis. And the commitment of the EIB group clearly is that the COVID crisis, as severe as it may be, as scalable as it might be, it is a crisis that we need to deal with in parallel to the other urgencies that we need to deal with, and climate change is definitely the most important factor in that.
Great. So I'm going to try to wrap us up on time in just a few minutes. But before we do that, you know, one of the things GSG has really tried to focus on throughout this summit is being really action oriented. And so I wanted to close by sort of asking each of you, you know, coming out of the conversations this week and the work that you're doing, what sort of one commitment or action that you're going to sort of take moving forward, be it sort of individually or you know, with other DFIs to both address the COVID challenges, but also to sort of improve the impact of your work. Jessica, why don't you start us off?
Great. I was hoping to copy from the others. No, I commit to seriously look at innovation and at new product development. I'm currently with one of my clients. I'm currently pioneering an impact-linked finance model, which is completely new. It's a completely different logic. It's kind of what has been mentioned, not looking at what goes in, but really what is the impact that comes out at the other end of it and incentivizing it. That's one example. Tackling the first-time female fund manager challenge together with CDC and EIB and the others in the 2X challenge. And looking at other types of innovation and really staying closer to our markets and hearing firsthand from those on the ground what is really needed and how we DFIs can be better and faster in providing solutions.
Yasemin?
Thank you. So I think for me, the trade finance instrument has been really compelling as an ex-ante, you know, hypothesis that this could be a powerful tool for our COVID response. I'm really keen to see if the data shows that it has been when enough time has passed. So I commit to monitoring that and sharing our learnings as we go into the next year, probably.
Great. And Uli?
I think the focus on my side is beyond the immediate response to COVID, to look into measures how we can use capital to equip ourselves to be better prepared to respond to this type of crisis in the future. And that is very much focused towards the area of innovation. How can we use technology available today and that is in development today in a way that equips us to be more resilient to this type of situation going forward. We simply cannot afford going another time through 6 months like the 6 months that we've just lived through, where we basically have stopped the life around the world in response to a crisis.
Right. Well, thank you all so much for sharing your work and sharing your thoughts with us. And thank you to all of the participants. And I hope you enjoyed the rest of the conversations today. I know there's also a workshop tomorrow about accelerating capital to SMEs in Africa that might be of interest to folks on this call.